Okay, let's dive straight in. We're looking at the UPS Q3 2025 results and their whole strategic plan. The mission here is simple. Give you the crucial info fast. Because this isn't just numbers, it's a huge transformation underway.
Exactly. And the headline, the consolidated numbers are out, and they smashed analyst expectations. It's a strong signal that their big strategic shift, trading volume for value, it's actually working. If you follow the freight market, this is significant.
How big a surprise are we talking? Consolidated revenues hit $21.4 billion. That beat the forecast, which was around $20.84 billion. But the real story, well, that seems to be on the bottom line.
Oh, absolutely. Look at the earnings per share. Adjusted diluted EPS landed at $1.74. Now, analysts, they were only predicting $1.30. So that's, what, almost a 34% earnings beat? Huge.
34%.
Yeah, which explains the market reaction, right? Shares jumped over 12% in pre-market trading right after the announcement.
Okay, so a beat that big. Normally you'd think maybe surprise revenue, but here it feels more like they just managed costs incredibly well. They reported a consolidated operating margin of 10.0%.
That 10.0% margin is key. It's up 110 basis points year over year. Now, 110 basis points, that's 1.1 percentage points. But for a company this size, that's, well, it's immense. And what's really striking, is why this Q3 beat happened. It came during this massive, deliberate strategic contraction. Their tight grip on expenses just successfully balanced out the volumes they planned to lose.
And they're not easing up. Looking ahead to Q4, the guidance seems pretty confident too, forecasting around $24.0 billion in consolidated revenue.
Right, and they're projecting a consolidated non-GAAP adjusted operating margin between 11.0% and 11.5%.
So higher margin expected in Q4 than Q3.
That guidance tells you they believe they can keep executing this strategy right through the holiday peak season, which is, the ultimate stress test. It really confirms the core idea. Deliberately shrink the low-margin stuff to zero in on that quality revenue.
Let's dig into that shrinking part then, the Amazon volume reduction, the glide down as they call it. That seems like the biggest strategic lever they pulled this year.
It really is. Amazon's total volume was down 21.2% year over year in Q3.
Wow, 21.2%. That's way faster than the first half, wasn't it? Like 13% then.
Exactly. Think about that. Your biggest customer, and you're actively cutting their volume by over a fifth. It sounds risky, maybe it is, but it's completely strategic. It lets UPS ditch that low-margin bulk and shift resources towards, well, higher value segments, small and medium businesses, healthcare, logistics, that kind of thing.
And did it work? Did they offset that lost volume with better pricing?
The proof is in the pudding, as they say. U.S. domestic revenue per piece, RPP, that grew 9.8% year over year.
Almost 10%. That's the best RPP growth they've had in 3 years.
Right. That's the payoff right there. It shows the volume for value trade is working. And if you break it down, about 3.5 percentage points of that came from base rates and package types. But a huge 4 percentage points came directly from improving the customer and product mix. They're successfully finding and keeping those higher-paying customers.
Okay, so the mix shift is working, but underpinning all of this is this absolutely massive organizational restructuring. The scale of the cost-cutting, it's almost hard to comprehend. Year to date, roughly 48,000 roles eliminated.
48,000. Yeah.
34,000 operational, 14,000 management. Just gone in 9 months.
We should pause on that. 48,000 jobs. I mean, that's the size of a small city restructured out of the company.
Yeah.
And it's not just people, it's infrastructure too. They've closed 93 buildings leased and owned just this year so far. Part of that network reconfiguration plan.
And the financial impact. $2.2 billion in expense reductions year to date already, which puts them right on track for their $3.5 billion cost savings target for the full year 2025. That's clearly what's driving that big margin surprise we talked about.
Absolutely. And there's a specific example that really highlights the financial logic here.
Yeah.
The voluntary retirement program for their drivers.
Right.
Costs about $175 million to implement.
Okay.
But the expected annual payback, $179 million.
So it pays for itself in less than a year.
Less than 1 year. That's textbook efficiency investment. Spend money now to save even more money almost immediately, year after year.
Okay. Overall picture looks strong, but let's get into the segments. U.S. domestic first. It tells a bit of a tougher story, maybe. Revenue down 2.6% year over year because of that volume loss, even though they eked out a tiny improvement and adjusted operating margin, just 10 basis points to 6.4%.
But hang on. If they cut 48,000 jobs and closed 93 buildings, how did their cost per piece, the adjusted CPP, still go up 10.4% domestically?
Yeah, that seems wrong, doesn't it?
It feels like a major disconnect. Where did the savings go domestically?
Well, they point to 3 things. First, just tough comparisons to last year's costs. Second, those union wage increases kicked in August 1st. That's a direct, unavoidable hit. And third, this ongoing challenge with density, specifically from their Ground Saver product.
Ah, Ground Saver. That's their lower cost, slower service, right?
Yeah.
Competing with maybe FedEx Ground Economy or the post office.
Exactly. And it's a classic density problem. Great for winning some volume back, perhaps, but
But if you're making more stops to deliver fewer packages for that specific service, your cost per piece skyrockets.
right. They estimated Ground Saver dragged costs down by about $100 million just in Q3 because of that density issue. Shows that core logistics challenge, empty space in the truck, is expensive.
Okay, so that explains some of the cost pressure. Is there a fix for Ground Saver's drag?
There might be. UPS just reached a preliminary understanding with the U.S. Postal Service. It's about volume and rates for the USPS to handle the final mile delivery for Ground Saver.
Ah, okay. So leveraging the post office's existing network density for that last leg.
Exactly. If that works out, it could really help stabilize Ground Saver's costs and maybe make it profitable heading into 2026.
Makes sense. Okay, let's pivot to international. Story there is quite different, mostly external factors, it seems. Average daily volume, ADV, was actually up 4.8%, which sounds good.
Volume up is good, yeah. But the adjusted operating margin decreased to 14.8%. So what happened there?
The main pressures were shifts in trade lanes, customers trading down to cheaper, slower services. Found a big one. The regulatory changes, specifically the elimination of the de minimis exemption in the U.S.
Right, the de minimis threshold, that's the value below which imports generally avoid duties and taxes, correct?
Precisely. When that threshold gets lowered or eliminated, the complexity for importing low-value goods just explodes. Suddenly, everything needs formal customs clearance, and you saw the impact directly. Volume on the key China to U.S. trade lane dropped 27.1% in Q3. That regulatory friction is a major headwind.
27% drop on that lane alone. That's huge. So how do they manage that explosion in customs complexity? More people?
Well, this is where technology comes in. They're using something called agentic AI within their next-gen brokerage platform.
Agentic AI, how does that help?
So when the rules changed, their daily customs entries surged tenfold. Went from about 13,000 a day to 112,000 a day.
112,000. Manually, that's impossible.
Totally unsustainable.
Yeah.
But this agentic AI system apparently allowed them to digitally process over 90% of those entries. It basically automates a huge chunk of the formal entry process, absorbing that massive regulatory shockwave for their customers. It's a big tech advantage.
Okay, interesting. So technology is cushioning the blow internationally. What about the third segment, supply chain solutions, SCS? Their adjusted operating margin surged to 21.3%. That looks incredible on paper.
It does look incredible, but there's a
Yeah.
big but.
Yeah, I saw that note. $330 million pre-tax gain from selling some properties, a sale-leaseback deal.
Exactly. 5 properties involved. They're monetizing assets to reinvest, which makes sense strategically.
But it does mean that 21.3% margin isn't purely operational performance, right? How much did that one-time gain inflate it? What's the real underlying picture?
That's the right question. And yeah, you have to mentally adjust for that $330 million gain. However, even taking that out, the segment seems fundamentally healthy. The growth is coming from the right places. Areas like healthcare logistics, which is high-value specialized work, and their digital access program, or DAP.
DAP, that's their online platform for freight booking and management.
Yeah, essentially their digital forwarder. It pulled in over $2.8 billion in global revenue just year to date,
And that's growing.
up 20% year over year. So yes, the reported 21.3% margin got a huge artificial boost, but the core strategy in SCS focusing on healthcare using digital tools seems to be working quite well underneath that.
Okay, so Q3 is in the books. Strong results overall despite the complexities. Now all eyes are on peak season 2025. They're expecting total peak average daily volume in the U.S. to be down year over year, which sounds weird for peak.
But again, it's by design, right? That's the Amazon glide down plan showing up during the busiest time. It's intentional.
So the focus isn't volume growth for peak, it's efficiency.
Laser focus on efficiency. They explicitly mention reducing reliance on temporary seasonal hires, fewer leased trailers, vehicles, even aircraft. It's about running the network they have more intensely, not just making it bigger temporarily.
And automation is the key to that intensity, presumably.
It has to be. They've rolled out new automated systems in 35 facilities just in the past year. The expectation is that 66% of U.S. volume will move through automated hubs in Q4. That's up from 63% last year. Every percentage point there matters for cost and speed.
66%. So the goal is run the leanest peak ever.
Essentially, yes. They're aiming to run the most efficient peak in company history. And they also want to secure their 8th consecutive year of industry-leading service reliability through peak. That service quality is critical for keeping those higher-value customers they fought for.
Makes sense. And what about capital? Are they sticking to their plans there, given all the restructuring?
Seems so. They confirmed the full-year commitments. Capital expenditures still pegged at around $3.5 billion. Dividend payments expected to be about $5.5 billion. So returning significant cash to shareholders is still a priority.
And share buybacks.
They completed the planned $1.0 billion in repurchases for the year.
Okay, so investing in the network, paying dividends, buying back stock, are they stretching themselves thin financially?
Doesn't look like it. They ended Q3 with strong liquidity. And even after accounting for the cash needed to close the Andlauer Healthcare Group acquisition that should happen in early November, they still expect to finish the year with around $5.0 billion in cash on hand.
$5 billion in cash. Okay, so financially sound despite the massive operational churn.
Yeah, they seem to have the financial footing to see this transformation through.
All right, so let's try and wrap this deep dive up. UPS is deep in a fundamental shift. They're deliberately shrinking volume, cutting an incredible number of jobs, 48,000 shedding buildings, all based on this bold idea. Shrink to grow margins. They're using network changes, tech like that agentic AI, and a relentless focus on higher value customers to make it happen. The pain of the cuts is definitely leading to margin gains right now.
Absolutely. This analysis really shows the strategic execution is delivering, record profits in some ways, even with huge headwinds like trade issues, and intentionally dropping their biggest customers' volume. But here's the crucial question left hanging, the one for you to really think about. These high margins we're seeing now, they're significantly boosted by these massive, arguably one-time cost reductions, closing buildings, eliminating jobs, banking those savings. Can the ongoing efficiency gains from automation and the better customer mix alone sustain these high margins into 2026 and beyond? Or will UPS need to find new rounds of major cuts year after year just to stay level once the low-hanging fruit from this big restructuring is picked? That's the real sustainability challenge they face next year. Can this new, leaner operating model stand on its own?